Hello, it's Jeff Christian from CPM Group. It's about 12:30 on Friday, the 5th of November here in New York. You can see from my screen, I have a lot of things I want to talk about. And there is an overwhelming theme or overarching theme to them all, which is that a lot of things are very complex. And when people oversimplify them, they get their analysis wrong and it often costs them money or worse. Um, so I'm going to talk a little bit about politics at the outset before we get into other things, but you can see there's a tremendous number of topics that are hot, and I may just wind up talking about headlines here without giving a lot of the details in order to not go on all afternoon. Before I start, I've been thinking a lot recently about two celebrities who are dead. One is Graham Parsons, who died in 1973. And when he died, his good friends in the band Poco wrote a song, Crazy Eyes, about him. And it's notable because, you know, here's their good friend dead, and they're expressing a tremendous amount of anger at how it was they excoriate him because he was so foolish as to do the things that he did that led to his death. And there's a line that's repeated called, "Who's been fooling whom?" Some of you may recognize it because I use it a lot of times when I'm talking about the fringes of the gold and silver market, where there are certain people who make a career out of fooling other people. And it's a big issue. The other one is Mart Saul, who died last week on the 26th of October. And he had such a great, sophisticated, knowledgeable, intelligent, acerbic wit. And it's something that this country really needs now. I thought about Mart last night because I was reading and watching some videos of how there were hundreds of QAnon believers who went down to Dallas and gathered in a square because QAnon had said that John Kennedy and his son John Jr. were going to come back from the dead, appear in Dallas, and reinstate Trump as president. And, you know, that's such a great thing to believe that it brought up Poco's thought, you know, who's been fooling whom? But I thought, you know, if Mort Saul were still alive and practicing his form of humor, he would have this skit with JFK pleading to God, please God, let me go back down there. And, you know, John can come too. You can keep Marilyn here as a hostage to make sure that I come back, but just allow me to go down there and spook these guys. Say, hey, I'm back. But, you know, let me tell you, Trump lost and he's not going to be president. We're not going to reinstate him. You know, yeah, God, you've done so many things, or you've allowed so many bad things to happen to humanity. Just do one solid for humanity. And let me go down there and say, no, you know, who's been fooling who? But Mart Saul's gone. So that's where it is. Now, this and the politics may seem a little bit aside from the metals markets, but they're not. They're heavily integrated. And they're heavily integrated for a couple of reasons. But let me go through some politics. The first thing is you've seen in New Jersey and in Virginia, people commenting how these blue states are not really so blue. And oh my God, you know, there's a Republican who has won the governorship in Virginia, which is a blue state. And in New Jersey, the race was very close in a blue state. And in New York, we have, you know, well, it was clear that Eric Adams was going to win because it's such a blue state in the blue city. But if you look at the number, Virginia, in the 26 years from 1994 until now, 12 of those years, almost half of them, were Republican governors. And coming from New York, I look at Virginia as pretty much a red state with little blue dots here and there. In New Jersey, in 16 of the last 26 years, so more than half of the last quarter century, they've had Republican governors. That hardly constitutes a blue state. It's a purple state, as most states are, in fact. And talking about red and blue states, and this blue state went red, is a gross oversimplification that misses very important nuances. If you go back to Virginia, where people are comparing this election to the 2017 gubernatorial election. But 2017 was radically different, and the Republicans had this guy Gillespie who was kind of a goof, and yet he lost by a big margin to Northam. But that's not really comparable to what happened with McAuliffe and Youngkin. I mean, McAuliffe didn't shoot himself in the foot; he shot himself in the head with his comments about how parents ought not to have any say in their children's education, and then doubling down on it and saying, "No, I really do believe that." So there's a lot of nuance there that these oversimplifications miss. And in New York, it's the same thing. 12 of the last 26 years, we've had Republican governors. If you go back over the last 60 years, we've had 28, or almost half of those years have been Republican governors. So it's not really a blue state. And in the city, 20 of the last 40 years, we've had a Republican mayor. So people don't understand that in New Jersey and in New York, and I don't know about the Commonwealth of Virginia, if you want to participate in a primary, you have to declare whether you're a Democrat or a Republican. And the Republicans never have a contested primary in New York, and to a large extent in New Jersey too. So people sign up as Democrats so they can participate in the primary, partly because they're democratically leaning, but also a lot of Republicans sign up so that they can vote for the most odious Democrat in the primary to come up against the most odious Republican who's foolish enough to run for governor or mayor of New York City. So if you think in terms of those poll registrations, you're really missing a lot of information, and you've got some basic bad analysis. And what you really need to do is look at the empirical evidence of voting records and realities. And all of a sudden you find out these are really purple states, and if you look at the next slide, this is actually from the front page of the New York Times yesterday. And this is the counties in Virginia, dark red or heavily Republican, dark blue, heavily Democratic. But if you compare this, not to Gillespie versus Northam in 2017, but if you compare this to presidential elections in 2016 or 2020 even, what you see is a lot of lighter pink, Republican leaning counties that normally are much more Republican. And you see more blue and light blue counties than you normally see. So it's really been a very mixed picture politically. And that's actually important to the precious metals and other markets for two reasons. The same oversimplification of complex issues that plagues the political analysis in the United States plagues financial markets, including gold and silver. And it compounds the difficulties for investors and other people to understand what's really happening in US politics, in US society, in gold and silver and stocks and bonds and finance. The oversimplification costs people in finance money, and in politics and society, sometimes their lives. So if you look at those 6 sets of factors that CPM Group says really determine investment demand for gold and silver, which really determines the price of gold and silver, political dysfunctionality in the US economy and political system, and political dysfunctionality in the domestic politics of most other countries in the world right now, and on an international political level, those political problems possibly are going to be more important than economic and financial factors in driving investors to buy more gold and silver, and thus driving the prices higher over the next 3 to 10 years. So politics matter. They're harder to analyze, and they're especially hard if you're being bombarded by oversimplifications. And God help us, we should have JFK come back here and explain it all. Now, going on to my next topic. There were 2 questions that popped up in response to our video on Tuesday. We talked about silver and we talked about inflation. And we responded in the comment section, but people within CPM Group agreed that maybe we should talk about them here. The first question was, please comment on physical versus paper contracts. And he said, what are the physical supplies out there? Leave paper contracts out. I appreciate your knowledge. Yeah, nice. But you know, other experts leave off paper, and other experts don't count the paper, which means their approach is different. Please let me know why they are always wrong. And emphasis added by CPM Group. Okay, first off, I'm not quite sure which experts they're talking about. There are some people who hold themselves out as experts of silver, and they actually include silver, some forwards, paper forwards. Forwards are paper transactions, they're credit transactions. They include some paper forwards, those that are done by silver producers, not by silver refiners or smelters or industrial users or other companies that will get involved in the forward market. They only include some of the paper forwards and they mix them up with physical supply, mine production. And they say, oh, well, you know, these producers are selling forward. And so that increases supply and depresses the price, which it doesn't. I mean, it does have an effect on the price, but not because it's increasing physical spot supply, but because it's changing the contango. And when they unwind their hedges, they think that they're somehow or other going off and buying otherwise sterile silver and thus increasing the demand for silver, which is wrong. There are other people who, I don't know what they believe, and I wouldn't necessarily call them experts. I think I would call them opinion leaders, maybe, that don't do that. Now, in terms of CPM Group's fundamental supply and demand statistics, we only include physical metal. And for 25, 30 years, since these other people have been talking about forwards from producers as somehow or other involving spot physical supply and demand, we have been saying, no, that's wrong. So we focus on the physical supply and demand. And if somebody would pop for 160 bucks and buy our silver yearbook, they would see 200 plus pages of physical silver in demand. And we clearly segregate physicals from derivatives. So I won't bore you with the details. They're there. You can see them here. You can look at the comment sections from the November 2nd CPM Group YouTube video, and you can see that kind of information. Now, I think one of the reasons that came up was because I had said something about the fact that there has been some investor liquidation of physical silver positions. And another question was, no, when you were fact-based, oh yeah, stroke it, boys. I have a question. If you factor out all the synthetic derivatives. Synthetic derivatives, that's sort of like tuna fish. Yeah, synthetic derivatives. If you only count physical silver, as if like we didn't, how much silver has been sold? We said, yeah, we have some metrics that we follow that show us that at least 55 million ounces of gross sales have occurred in the last several months in the physical silver market. And we have other metrics that we follow that suggest that there may be 2 or 3 times as much. Now, all investors in gold and silver like gold and silver in part because of the secrecy, and they tend not to give up those numbers. They tend not to do that. But as I said, CPM Group, because we've been in this business for 40 some odd years, we have metrics that we have plugged into that give us some indication there. You know, now the guy goes on and says, well, you know, how can you say that there's ample record silver inventories when the mint couldn't find silver? And it harks back to this press release where somebody said, well, we couldn't get enough silver. And the mint explained it, that it was not that there was a shortage of 1,000-ounce silver bars, but that there was a shortage of silver blanks that met the mint's very stringent blank qualifications. Mint has the most stringent specs on their blanks of any mint in the world, and they were having problems getting enough blanks that met their specs. And somebody misrepresented that in a press release from the mint, and then the mint came out and said, no, we clarified it. Now, this other guy who says, I'm not stupid, no, you're not, you're just deluded, said, oh yeah, well, I saw that forced retraction. It was not a forced retraction. It was a clarification of something that was said inappropriately. And unfortunately, JFK couldn't come back to life to say, no, it wasn't that there wasn't a record amount of silver in inventories. On a reported basis, unprecedented in a highly secretive silver market, it was that there was a problem with the blanks. Yeah, I can't help people who are deluded who've been fooling whom. You need a psychologist, not a metals analyst for that kind of stuff. Okay, so those are the first two things. Now, another issue I wanted to talk about, we talked about electric vehicles and future energy supplies in a video, I guess a week ago. And it got a lot of interesting comments and a lot of attention and stuff. There's a whole set of issues called on the metals availability to meet the demand for these metals, to make the electric vehicles, to make the electrical storage systems, to store off-peak power that comes from renewable energies and nuclear power, and the overall electrification. And the International Energy Agency did a big study this year on the implications for various critical minerals of the shift toward electrification. And it's a really big issue. And it's a big issue, which I touched on in my video last Friday, because I said the IEA in its annual energy outlook report, which came out last month in October, said ignoring non-economic barriers, electric vehicles will take X market share. And I said you cannot ignore those non-economic barriers. One of the big non-economic barriers is where you're going to get this metal. If you're looking at lithium-ion batteries and they use a lot of cobalt and there's not enough cobalt, so now they're shifting away from cobalt to manganese, and specifically high purity manganese and high purity manganese sulfate, and there's not enough there. And incidentally, probably 90% of the high purity manganese sulfate that's manufactured in the world comes from China. And the issues of China's relationship with Europe and the United States and Canada has come in big time. So that's a non-economic barrier that's really important. And it's not just manganese, it's not just cobalt, there's other issues with other metals and other materials, and the manufacturing of motors. And the lack of capacity to make motors suitable for electric vehicles in the volumes that are needed to meet these outrageously high projections of the rate at which electric vehicles can catch up. So those are really big issues that are probably going to slow the movement to electrification and the growth in market share of electric vehicles, which is number 7 in my list. You know, CPM Group has just, well, we're completing writing them up, but we've done our data of our annual update of our views of how many autos are going to be produced and sold annually between now and 2050. We go out 30 years right now, 29 years right now, to 2050 in our projections of auto production and sales, electric vehicle and fuel cell vehicle and hybrid vehicle market penetration over the next 30 years. And what does that mean for platinum group metals, platinum, palladium, rhodium? What does it mean for manganese and cobalt and everything else? So we're going out for 30 years because that's how long you have to look at it if you're building a mine. And by the way, let me back up and talk a little bit about manganese. I mentioned it's high purity manganese and high purity manganese sulfate that are the places where you don't have sufficient capacity, and most of the capacity is in China to make that stuff. You look at the manganese market, and most, more than 90% of the manganese that's mined goes into ferroalloys. And when you look at the implications of the advent of electric vehicles and electric vehicles gaining market share going forward, and you look at the implications for prices of manganese, and you find is that for manganese metal, it probably has very little price effect. But for high purity manganese metal and high purity manganese sulfate, it has an enormous effect because those are much smaller markets, and that's where the demand's going to be. So it's very similar to saying, oh, well, the mint can't get silver blanks, ergo, there's no silver left in the world. No, there's an enormous amount of silver, but it's not in high quality blanks that meet the US Mint's form. Oversimplify complex issues and you lose money. Or you will listen to people who are oversimplifying complex issues and you lose money. So that's another issue. Now, let me just sort of see here. This is platinum, and I want to point to platinum in the 80s because it relates to the capacity constraints for metals going into electric vehicles, ESS systems, and electrification, and how it went. In the 1970s, we passed the Clean Air Act in 1970. In 1973, we started with model year 1974 for US, cleaning up some emission standards. In 1980, we added the NOx, and all of a sudden you needed rhodium as well as platinum and palladium. But the critical thing is here, around 1983-84, Europe agreed that it would start introducing emission standards on its vehicles in the late 80s, early 90s. And you saw this extended period of time here where supply, mostly mine production at that time, was exceeding fabrication demand. And the price of palladium was weak as a result of this oversupply. It was a conscious decision because the auto industry said, look, when Europe kicks in with emission standards, we're going to need a whole lot more platinum, palladium, and rhodium. And the South African producers said, well, you need to give us investment, you need to give us offtake agreements with firm prices and volumes so that we can borrow the money to build these mines. Because you can't just turn on these mines when you say, okay, it's now 1988, I need that platinum, palladium, rhodium. We have to build these mines and fine tune them and get them up to par in advance of you needing our metal. So the auto industry in the early 1980s gave the South African producers 10-year offtake agreements saying, we're going to buy X ounces, at least X ounces of platinum, palladium, and rhodium at X dollars per ounce on a 10-year basis. And that will give you the confidence to go ahead and borrow the money and build those mines so that when it happens, the metal's there. Now, unbeknownst to all of those guys that were involved in that, and they were mostly guys, in 1989, the Soviet Union started to crumble, and in 1991, it completely crumbled. And there was a whole lot of platinum, palladium, and rhodium that was stockpiled by the Soviet government, which was then sold. So if you go back to 1985 and what the South African producers and the auto industry were saying was, okay, we're going to see this oversupply period. And around 1988, 89, emission standards start kicking in Europe, and this surplus, annual surplus, starts contracting. And we've got some metal that we've built up in inventories later so that there's some slippage. But what happened was with the collapse of the Soviet Union, there was a flood of platinum, palladium, and rhodium into the market, and you had a much longer period of time, which further depressed the platinum price until 1980. That's important for platinum. It's a very good lesson, but that is what's not happening with manganese and cobalt and lithium and rare earths and everything else. The auto industry and the electrical generating industry and the electrical storage systems and the electrical grids are not going to mining companies and saying, we will give you long-term offtake agreements with minimum volumes and minimum prices and minimum values of revenue, because the technology is too uncertain. We can tell you today that we're going to need a lot of manganese, but let's be honest. 4 years ago, we were saying that we were going to need 30% cobalt sulfate in our batteries. 4 years ago, it was 20% cobalt sulfate. Last year, it was 10% cobalt sulfate. And now we're thinking maybe we don't need any cobalt. So there's a tremendous of uncertainty, not just with the metals, but with the motors and the controllers and every other component that goes into these electric vehicles. And those are non-economic barriers that you have to pay attention to, because they're going to slow the transition. So that's one of the things. The PGM experience tells you a lot about why we probably are not going to see market share of electric vehicles rise as rapidly as people think. We have it rising very sharply over the next 10, 20, 30 years, but much more slowly than what you would expect if you listen to the politicians and the corporate leaders in the auto industry. And I should say, our projections for the next 10, 20, 30 years are not that far offline from the International Energy Agency, which is this unbiased intergovernmental agency that is charged with trying to accurately project supply and demand of energy across markets in the short and long run. Another factor in there is the rise of precious metal, of Russia and China as sources of material. Now, I've talked about that in terms of gold and silver, but it's also true, as I said, with high purity manganese and a variety of other metals. And the reality is that the world's becoming more dependent on countries that Europe, Canada, and the United States are increasingly hostile. So you really have to worry about that as a factor going down the road. I want to talk a little bit about the COP26 and beyond. Watch for the consequences in a shift in government policy away from containment of carbon dioxide to mitigation. Climate scientists already are suggesting that we've lost the game of trying to reduce carbon dioxide and slow global warming. You know, governments have been so governmental in doing this that it probably is a lost cause. And what we should be doing is taking the scarce resources, money and focus and attention and efforts, and instead of trying to contain carbon dioxide emissions, we should start spending that money and that time and that effort on mitigating the consequences of global warming. Having been unable to reduce carbon dioxide emissions and slow global warming, let's start building seawalls and get rid of those federal tax insurance programs that say, hey, if private insurance companies are smart enough to not insure your oceanfront property, the federal government will. You know, we should start looking at mitigation. That is an interesting concept. A, it's very sad. B, it's probably true. But C, that would be the ultimate capitulation. And you have to think, what would people think? What would the population think if governments said, okay, yeah, we just blew it. We're not going to be able to do that. The key is to look at mitigating the damage that's going to be caused by our profligate use of fossil fuels. You know, think about the fallout for politicians and governments when they say, yeah, we kind of blew it there. Kind of an interesting thought worth throwing out. I wanted to mention tantalum. Tantalum is a fabulous metal, very interesting. World's heavily dependent on the Democratic Republic of the Congo right now for tantalum. It's used in semiconductors, it's used in capacitors, it's used in high strength, high temperature ferroalloys in jet engines and other things. CPM Group has begun a tantalum research and consulting practice. We're going to be producing tantalum quarterly reports. We're going to be advising companies on a consulting basis, and we will be doing bespoke research on tantalum with 10-year projections. It's very important. There was a company that produced tantalum research. They've gone through some ownership changes, and they have gotten rid of their tantalum analyst. And so he's working with us now, along with another person, and we're building out our tantalum practice. We opened that up a week ago, and we're doing that. Now, gold and silver market update. I often tell people who are thinking about investing that there's a big gulf between analyzing markets and investing properly. And in the last 3 months, really since the beginning of August, CPM Group has been able to call the short-term price moves relatively well overall. But in terms of our trade recommendations and, you know, buy now, sell now, we've gotten it wrong. We had said that we thought that the precious metals prices would be kind of moving sideways in trading ranges, and more or less they have. And we expect them to continue to do that, as I've talked about in recent years. But it seems like whenever we say, well, maybe this is the bottom of the range and you should buy, it goes lower. And when we say this is the top of the range and you should sell, it goes higher. And it's the nature of asymmetrical markets where there's a tremendous amount of secrecy. But we do see gold and silver trading sideways. And as I speak, gold has broken above $1,800, primarily because of greater economic optimism and greater inflation expectations because of a relatively healthy employment report this morning in the United States. The dollar's higher, oil's higher, the stock market's much higher. Gold has broken above 1,800. Silver has broken above $24 on a temporary basis. We still see the prices moving broadly sideways for the next period of time, the next several months. But as we've said all along, we do think that the trend is toward higher prices in the longer term. And we have been telling people from a intermediate to long-term investor perspective, you probably should be buying gold and silver, not selling it, which also flies in the face of some of those other comments that we just generally choose to ignore. That's all I have, a lot of headlines. I will point out that for our clients, we will be having an open forum on November 17th. It's an online event. We have no presentations. People can send us questions and topics and issues that they want us to address in that, or they can ask the questions live during the open forum. Those are open to our clients, both our institutional clients and our retail investment product clients. If you want information on our retail investor programs, because you'd like to plug into that, or you'd like some other information and research and trade recommendations on gold and silver, you can go to the website shown here and sign up for our retail investment products. You can plug into the open forum. You can buy our yearbooks, so you can read all about physical gold and physical silver and physical platinum group metals, as well as the derivatives. But I'll be honest, the derivatives are reduced to one chapter at the back of each report. Most of the reports are about physical metal. Sharp contrast to other experts. And you can find an introduction to CPM Group and all the stuff that we do at that other website. And there's a YouTube video where we talk about it. And we're always there to help you with research-driven, unbiased, fact-based research and consulting. Gold, silver, platinum, specialty metals like manganese and tantalum and tungsten, and commodities and commodities investments in general. That's all I have for now. Sorry I went so long, but a lot of ground to cover as we get ready for the winter. I'll talk to you next week.